IRS 1099 DA reporting starts in January 2026. What crypto traders must report and why it matters. What is the IRS 1099 DA form for crypto? Starting January 2026, U.S. connected crypto exchanges like Coinbase, Kraken, Gemini, and Robinhood will begin issuing a new tax form, the 1099 DA. DA stands for digital assets, and it functions like other 1099s by reporting taxable events back to the IRS. What counts as a taxable event? Sales and transfers. Purchases alone won't be reported because they're not taxable. Transfers to or from other persons are taxable. Transfers between your own wallets are not. This distinction is not reported to the IRS. This form is not optional. If you've sold or moved crypto off a centralized U.S. exchange, expect to receive one. What does the 1099 DA let the IRS see about your crypto? Because the 1099 DA gives the IRS direct insight into every crypto sale you make on that platform, every transfer you initiate to an external wallet, the wallet address where you sent funds, the asset and its value at the time of sale or transfer. Even though the IRS won't get cost basis info in the first year, they'll still receive large transaction amounts without context. That opens the door for misleading assumptions about your gains. In Clinton's words, just big numbers. When will 1099 DA crypto reporting begin and what will be included? 2026. First 1099 DA forms issued for tax year 2025, 2027 onward. Exchanges expected to include cost basis if known. In year one, they'll only report gross proceeds. That means if you sold $250,000 worth of crypto, but your cost basis was $240,000, the IRS sees only $250,000. Without the full picture, you'll need to prove your real gains. Will crypto wallet transfers be reported on the 1099 DA? Let's say you transfer $10,000 of BTC from Coinbase to a Ledger wallet. That transfer will be reported, including your Ledger wallet address. From there, the IRS could trace wallet-to-wallet movements and create a picture of your full portfolio across multiple assets and chains. This includes Bitcoin, Ethereum. Any coin supported on the reporting exchange, the IRS won't know it's your ledger, but they'll know the address. If they choose to follow up, you could be asked to explain those funds. Will crypto wallet transfers be reported on the 1099 DA? Let's say you transfer $10,000 of BTC from Coinbase to a Ledger wallet. That transfer will be reported, including your Ledger wallet address. From there, the IRS could trace wallet-to-wallet movements and create a picture of your full portfolio across multiple assets and chains. This includes Bitcoin, Ethereum. Any coin supported on the reporting exchange, the IRS won't know it's your ledger, but they'll know the address. If they choose to follow up, you could be asked to explain those funds. What happens if you don't report your 1099 DA? Let's say you get a 1099 DA in 2026. You disagree with the numbers, or maybe you forget to include it in your tax software. The IRS will notice. If it's missing from your return, the IRS may assume you underreported income and issue a CP 2000 notice, billing you for what they think you owe. That's not a bill you want to receive. Even if you disagree with the 1099 DA, you still have to report it. We'll cover how to adjust for incorrect info in a follow-up post. But for now, report it first, fix it later. Does the IRS collect wallet addresses under 1099 DA reporting? Many crypto investors are concerned that wallet addresses are being reported, but the IRS says wallet addresses aren't personally identifying information. They say the data is transferred securely. They say it's kept private. You decide how much you trust that. Don't forget that IRS contractors stole Donald Trump's tax returns and published them. What's certain is this. Over time, the IRS is building a detailed map of your digital holdings. How CryptoTaxAudit helps you defend against IRS. 1099 DA enforcement. The 1099 DA is just the beginning. The IRS is building a comprehensive surveillance system around your crypto activity. Wallets, transfers, trades, and addresses. It's no longer enough to file. You need to be defended. At CryptoTaxAudit, we specialize in exactly this. Our team helps crypto investors to calculate accurate gains using proven methods that withstand scrutiny. We prepare compliant, defensible tax returns. No guesswork. We provide full defense against IRS notices, audits, and aggressive enforcement actions. when it matters most. Whether you're holding coins on Coinbase or moving between private wallets and DeFi platforms, we make sure you're covered. Don't wait for the IRS to send you a notice. Visit CryptoTaxAudit.com and secure your portfolio today. Before we wrap, let's run through some of the most common questions crypto investors are asking about the new 1099 DA rules and how Crypto Tax Audit can help you stay ahead of the chaos. This one comes up a lot. Who will receive a 1099 DA? Anyone who sells or transfers digital assets on a US-connected centralized exchange. A key question we're hearing lately. What's reported in 2026? Only gross proceeds from sales and transfers. No cost basis in year one. Here's a scenario that worries a lot of traders. Do I need to report the 1099 DA even if I disagree with it? Yes. Failing to report can trigger IRS notices. You can correct the numbers later, but you must include the form. Now for something that confuses almost everyone. Does this apply to wallets and DEXs? No, DEX aren't required to issue 1099 DAs, but centralized exchanges are, and they will report wallet addresses for transfers. And finally, the big one. How can Crypto Tax Audit help me? Crypto Tax Audit helps you calculate your gains, defend your numbers, and prepare for audits before the IRS ever knocks. If you're confused or worried about the 1099 DA, this is the time to act. Visit CryptoTaxAudit.com to get protected. Key takeaways. The 1099 DA will be issued by US-connected exchanges starting in January 2026, reporting 2025 crypto sales and transfers. Wallet addresses will be reported, creating a new layer of IRS surveillance. The first year will report proceeds only, no cost basis, leading to overstating your income to the IRS. Failing to report the form can result in IRS audits, CP 2000 notices, and inflated tax bills.